Okay, sounds good.
Hello, everyone. This is the Anderson Report. I am Tim the Source Anderson. Uh, it came to our realization yesterday. It came to our realization yesterday after the broadcast that there were there was a problem with the chat where I don't see most people in the chat. I didn't see. See, I know that Maddie is in the chat right now. There might be some other people in the chat. I don't see any of those comments. I've got my technical guy on the phone. If everyone can just bear with us for 3 to 5 minutes, I'm going to turn my live mic off. I'm going to continue talking to my technical guy, and we're going to see if we can figure out what the issue is here. So we are going to do a show tonight. There's plenty of things to talk about. The S&P closed at a new high, although the internals of the market weren't very impressive. And I'm just going to turn off the mic for maybe 3 minutes or so while I continue to have a phone conversation with my tech guy, and we'll try to get this chat issue resolved. Okay, thank you everyone for bearing with us for a couple of minutes. There's a glitch in the system where on my straight feed here, I don't see anyone in the chat, but I've got YouTube up on a tablet right next to me, and now I can see everybody in the chat. Maddie, Pablo, thank you for joining us. Eric, it's great to have you with us tonight. What I'm going to do, if you see me glancing off to the side on occasion, I'm just looking at what the chat says in my version of the YouTube feed that I'm running on my tablet. So it might be delayed by a few seconds, but there's a fair amount to talk about, and I will be looking for your questions as we go on. So, excuse that little delay, but it's only a 5 or 6 minute delay. There is a fair amount of things to go over tonight. But we're going to start by a little history lesson that today, August 18th, is the 38-year anniversary of the beginning of the secular bull market that myself and a number of other people feel that we are still in. And that was August 18th, 1982, the first day that volume hit 100 million shares on the New York Stock Exchange. Believe me, it was a completely different world than the one that we are in today. The Dow Jones Industrial Average gained about 5% that day. It paused the following day and then went on to gain about 10% on the week. That was right in the middle of the third week of August, what typically would have been the really the dog days of summer, especially in 1982 when average volume on the exchange was running maybe between 50 and 55 million shares a day. That's for the entire exchange. That's just not one stock. You have stocks today that will trade hundreds of millions of shares today, a day. So to say that it was a completely different world is an understatement. John, it's nice to have you join us. And so the Dow, it's hard to imagine the Dow Jones Industrial Average was right around the 800 level at the time, 800. The Dow Jones is now close to 28,000. That was 38 years ago. And really, that was an environment where we talk about interest rates right now, the 10-year note be trading at 0.65%, the 30-year bond trading at 1.4%. Back then, 30-year bonds traded at around 15, 16%. And there was a period of time just before then when short-term notes traded at 20%. So it was hyperinflation, and basically the proclamation by a couple of very key, very senior, and widely followed and respected around the globe economists, Henry Kaufman, who was the chief economist at Salomon Brothers at the time, and Albert Wajnlauer, who was the chief economist at First Boston at the time, basically in messages to their clients or in letters to their clients, clearly, no email and or phone conference calls, proclaimed that the bear market in fixed income securities was over, and that we would never see interest rates again that high for a generation. They were very right. We haven't seen them that high for a few generations, and the bull market was on, with some well publicized fits and starts along the way. I don't know how many percent we're up from there, but if anyone wants to put it into their calculator, 38 years ago, the Dow Jones was somewhere around the 800 level, and now we're at 28,000. It's been a wild ride. So let's talk about today. The S&P 500 closed at a new closing high today, almost 6 months to the day from its prior closing high on February 19th. Today is August 18th. Am I right on that? Yes, it's August 18th. We are almost 6 months to the day, and we've got a new closing high from the S&P 500, only by a few points, and there wasn't a lot of gusto to it late in the day. In fact, it traded off a little bit in the last 15 minutes of the day, but the S&P 500 closed at 3389.78. The old closing high was 3386.15. So by less than 4 points. But you know what? We'll take it. The S&P was up only 0.2%. It had, gotten very close yesterday. It's had a number of near misses over the last week. The Dow was off a little bit, off 65 points. That's only 0.2%. The financials were weak. Energy was weak for like the third day in a row. The Nasdaq was positive. The tech space strong again. It's like a never-ending story. Nasdaq posted another new high. It had posted a new high yesterday. It closed at 11,210, up 80 points. That's about a 0.7% gain. And Greg, I'll get to that in a minute. So the Nasdaq, another new high, fueled by you know the names, the big internet traffic trade stocks. Russell 2000. That's kind of where all the positive stuff on today's market ends, with the Nasdaq and the S&P hitting a new high, and the S&P widely anticipated, being talked about for a number of times. I got a number of phone calls middle of the day today from some financial media people I know. Do you think this is it? Are we going to hold up here? Do we need another push? How are investors going to take it? I don't know. It wasn't with a lot of exuberance. It wasn't with a lot of tremendous amount of volume, but it was a new closing high. So I think we'll, take a close look at that tomorrow. But the Russell 2000, which has been acting quite well, didn't really act well at all today. I don't have anything good to say about it. It was down 1%, down 15 points. It certainly felt like there were one or two big funds that were doing a sector allocation trade where they were selling small cap names and buying other names, maybe because they're a little bit worried about the economy taking a dip. Maybe because they don't like the action, and that might be consistent with the fact that the bank stocks act awful. And I mean awful. The financial sector was down 0.7% today, but Citigroup down close to 2% again today. JP Morgan down close to 2% again today. State Street held up a little bit better, but the big money center banks, there's no other way to put it, they just don't act well. Greg, I don't have a great answer for you. Our financial stocks doomed in the near term. Hurts to hold them. Yes, I'm sure it does. I just don't. I'm first of all, I can't really comment on individual stocks. I can talk about sectors a little bit. I am a registered person with FINRA. I am not a registered stock market analyst. So there are big compliance issues with me talking about individual stocks in any way that people may feel like I am giving um, buy or sell recommendations or advice. I can tell you what their earnings were and how the market reacted to it. I can talk about, sectors and so forth and give you a couple of hints. But clearly, look, I don't have the answers for that question, Greg. I wish I did. Um, they are not in a growth sector, and I would think that if people really believe some of the polls that show Joe Biden with a strong lead over Trump going into the November election, that could be a reason for energy and financials to be underperforming, since there would most likely be a regulatory stranglehold put on the financial sector, especially if Elizabeth Warren became a leading voice again in financial regulation, and also the far left uh, radical plank of the Democratic Party, which seems to be pretty much in control of their messaging, and I'm sure would have a major influence in their policies also. All they have to do is do a quarter or a third of their Green New Deal fantasy to do significant damage to the energy sector going forward, which would be a just a terrible, terrible event for the U.S. economy, especially given that we worked for years, if not a decade or two, but extreme amount of work done with the fracking and shale industry over the last 5 to 6 years to become energy independent. So to flush that all away would just be a really not a very smart move. If if there are some investors out there that think that that's a legitimate possibility, that Biden could become elected, that could be a reason for the weakness in the financial stocks and in the energy sector. Uh, and we are, of course, a couple of days into the Democratic convention. Um, but let's go back and talk about what else was going on in the market today. Transports that had a big run, um, down a little bit today, a little bit less than 1%, still at 10,865. That's not bad given the run that they had in July, where they went from 10,000 to 11,000 pretty much in a straight line on the Dow Jones transports. So we got a little bit of dichotomy today in the market. The S&P holding in there with a very moderate gain that put it at a new closing high. Nasdaq grinding its way a little bit higher on the strength of the everything fueling the internet traffic trade. Advanced declines negative by 3 to 2 at the NYSE, 3 stocks declining for every 2 that advanced. On the Nasdaq, despite the fact that the Nasdaq Composite gained 0.7% and closed at a new high, there were 5 stocks declining for every 3 that advanced. So the market breadth is not very impressive. I would think that there would be some people in the Twitter sphere that follow the financials quite closely, and even you'll read potentially some market comments tomorrow that the quality of today's rally was not very impressive. Crude oil was down a touch, but still holding the 42.50 level, down like only 35 cents. Crude oil at 42.50 is we like to see that. And certainly not consistent at all with energy being down 1.3%. Gold rallied again, went through the 2000 level, which it had been gone through a couple weeks ago, like it was really no big deal. Up $20 to it's really 1%. Gold went out at about 2010. So there were a couple of big pieces of earnings, but we'll get to the raw data, the economic data first. Housing starts, very, very strong numbers. It was widely anticipated that housing starts would be strong. They were strong. They blew through expectations pretty easily. Um, and we had housing starts of just under 1.5 million. And when I say just under, I mean by just a small amount. Basically, 1.5 million housing starts in July versus expectations of 1.25 million. And building permits also just the smallest amount, under 1.5 million versus expectations of 1.32 million. Um, we'll get more housing data later in the week when we get new home sales. We either get new home sales or existing home sales on Friday. It's not till Friday. I'll freshen that up before then. So the home builders were a little mixed today. They'd had a very strong run. They were all up yesterday in anticipation of this number. You also had Home Depot's earnings earlier today. Very strong number. They beat consensus, although the stock was down a touch. I'll get to the stock reaction in just a minute. But the Home Depot is also in the home building in ETF, the main home building ETF, kind of the benchmark everybody looks at, the XHB. Look, it's up 17% year to date. The XHB is the home building index. There's not only home building stocks in there, but there's also building material stocks in there. There's Home Depot's in there. Lowe's might be in there. I think Stanley Works is in there. There's a lot of stocks in there to do with home building, home remodeling, home fix it up type stuff. A lot of things other than just home builders. So it's up 17% year to date. It's 8% above, which was above what was the February high. It had reached a high like a lot of things in February. It's 8% above that, where the S&P 500 is really just right at that level, made a new high by 3 points. And Nasdaq well above the February high. The Dow not quite to there. So the XHB home building index has had a big move. If you want exposure to the home building market, it's worth looking at. The only caution I would have is it's had a big move. It's up 17% year to date. It's 8% above what was its February high. Now, let's get to a couple of interesting earnings reports this morning from both Home Depot and Walmart. They both had great earnings. They both crushed their earnings numbers, their sales numbers, their revenue projections, et cetera, et cetera. Both stocks were down a little bit. And both companies specifically cited concern over consumer spending dropping off if there's a failure to get a stimulus 4.0 package that includes raw cash in the hands of consumers sometime, obviously right now we'd be looking September best case since the House is on recess. So investors took that as maybe a little bit of caution, maybe feeling that that a lot of consumer spending was fueled largely by the added $600 unemployment kicker that everyone's heard all about, and the stimulus checks that went out a few months ago, and the prospects of another round of stimulus checks. The only thing I would say in this regard is that it's a little bit their extreme caution on consumer spending going forward is a little bit inconsistent with the best acting sector of the S&P 500 main big 11 major sectors, was consumer discretionary, up 1.5%. So if investors overall were that concerned about the level of consumer spending, particularly in the discretionary category, they didn't show it in a lot of other stocks that they were going after today, with consumer discretionary being up 1.5%, communication services being up 1%. That's a little bit of your internet traffic trade. So, you know, obviously that consumer discretionary is things that people want versus consumer staples, which is things that they need. Up 1.5% today. I think that what the administration is trying to do is hit some type of a um, focal point or happy medium where they feel they've got to scale down that $600 extra unemployment kicker that the Fed was putting in, because that was inhibiting or disincentivizing people from going back into the job market, but still giving people at the lower end of the income threshold uh, uh, some extra unemployment benefits, since the fact that most of them are unemployed is not really their fault. It's because of the shutdown, and a lot of the hotels, restaurants, indoor activity type venues remain shut down or at very minimal capacity. So I think maybe they're thinking, you know what, $300, we'll call it 400, and we'll tell the states they've got to kick in 100. If they don't, it's still 300. Maybe that's enough to make sure people can pay their bills and have enough money to buy groceries and have enough money to buy all their essentials. But it's a lot. It's enough of a decrease from what it was to incentivize a lot of people to go back to work, because we really need more people to go back to work, because the job and employment portion of the economy is the one area, and very critical area, that has lagged the uh, second stage of the V-shaped recovery that we've seen from housing, home building, uh, internet shopping, online shopping, even consumer spending. And we mentioned it the other day, but when the retail sales report came out last Friday, the headline number was up 1.2%. It was up 1.9% ex autos. And let's see if I can get this chat to refresh. And but the striking piece of data to me in the July retail sales report, and even though that number comes out sequentially, which means they always compare it to the prior month, whereas like in the GDP reports, they compare it to the same quarter of the previous year, they said that retail sales for July 2020 was 2.7% higher than retail sales for July 2019. I found that to be a striking data point, and really a sign of how strong the economy was throughout the second half of last year and into the first couple months of this year, before we had the big drop off, that retail sales has gone up so much that even though we're nowhere back to where we were in December, January, February, just before the economy got hit hard, we're still close to 3% above July of last year. And look, August numbers will be interesting. There's no doubt about it. You probably won't have it. Maybe you might not have as much back to school shopping as you would typically have, because a lot of schools are starting out virtual. But we'll see how that, we'll see how that progresses with the school picture. Now, a couple of other key things from Amazon's earnings report. They're expanding big in 6 cities, adding 3,500 corporate jobs, clearly at the management and logistical level. They had almost 100% growth in their e-commerce business. Clearly, they're coming from a much, much, much lower base. If I said Amazon, I mean Walmart. Walmart. These were Walmart's earnings. Their Amazon is expanding in 6 cities, adding 3,500 corporate jobs. Walmart stated, that was just a random headline. Amazon reported earnings 3 weeks ago. Walmart saw 97% growth in their e-commerce business and had tremendous growth in e-commerce, up almost 100%, but clearly coming off a much lower base than a lot of its competitors. Same store sales for Walmart, up 9.3%. Expectations were for up 5.3%. That being said, the stock was close to a 52-week high. Target has been at a 52-week high. The stock did sell off a little bit. We'll see where Walmart is maybe a week, 2 weeks from now, after it digests everything they said on their conference call, and people really dig in to some of the details in their earnings report and in their sales metrics. Clearly, because it's Walmart, it's a very elaborate report with a lot of detail in it. Okay, so we'll take just a quick break since we were doing a little bit of maintenance earlier, and I'm a little concerned that the chat is still running, even though I'm looking at it over here. I see a number of people in the chat, but I don't see anything in the last 10 minutes, and that's okay. But if you do have questions or there's anything you want me to address, please throw it in the chat. I think that's a big part of this broadcast. So I think it's up to date. I'm looking at, I usually don't do this, but I'm running the YouTube feed on my tablet next to me because there's something wrong with the connection I use from my streaming service that goes out to both YouTube and Periscope. Basically, in this chat here that I usually look at when I do my broadcast, which is why I see that, Maddie. Thank you very much. The reason that you see me on occasion when I'm doing this broadcast tip my head back is because I wear progressive lenses, and I have to look under the bottom of I have to look at the very bottom of my lens because I'm sitting so close to the Chromebook that I use for my video camera, that when I want to read the chat, and of course I'm dating myself with this, but I have to look at through the bottom part of my lenses to read the stuff in the chat. That's why you will see me on occasion tip my head backwards and look at the screen. I know it probably looks a little funny when I do it, but otherwise I can't read the chat. When I look at the tablet next to me, I should do this on a regular basis, because when I look at the tablet next to me, I can see the chat. It's just low positioned in a way that I see it through the bottom part of my lenses. But this is the Anderson Report. I am Tim the Source Anderson. I really appreciate everyone's support that's given this channel over the last month or so. And this is my YouTube channel, The Anderson Report. We do this typically 7 p.m. Monday through Thursday. I think we're gonna add Sunday as a regular broadcast day, because we had a lot of viewers this last Sunday and the previous Sunday. And occasionally we'll do one at a different time, just depending on a couple different factors. I know that no time is perfect for everyone. That's why you can always watch it on replay, ideally on YouTube, or probably even on Periscope after the fact. Try to keep it to about 40 minutes. Might go a couple minutes extra today because we were doing some checking a couple of technical bugs that we had right when we started this morning. And I know that the broadcasting that a lot of people like to watch at 8 o'clock is a little bit different this week. So I used to like to finish by 10 to 8 because of the Democratic convention. Um, some of the some of the news broadcasting is um, altered a little bit this week. So we mentioned the retailers. We have a couple other sectors to mention. We mentioned energy. Energy underperformed. Industrials down 0.5%. They were the best acting sector last week. Financials down 0.7%. Financials just act awful. I don't really know what to say about them. If you're gonna be in them, you got to realize it's going to be a long haul. If the economy, there's no doubt that when the economy gets back in gear, and when the economy does improve, and when we get more people back to work, and when we get through some of the capacity constraints for hotels, restaurants, bars, sporting events, any other indoor activities, the financials will do better. But they're, it's going to be a long haul. Uh, in the bond market today, 10-year note, there was buying in the bonds today. So the 10-year yield did go a little bit lower. It had touched 0.72 last week. It's back down now to 0.65. I would love to see it hold that 0.65 level. I don't want to see it go back down below zero point 0.6. That's just a sign that the economy is not really, uh, gaining strength. And it may be a reason with the 10-year note pulling back from 0.72 to 0.65. It doesn't sound like that big of a move, but when almost everything on the curve is trading below 1%, it's a big move on a percentage basis. That may be why the financials have underperformed. The financials had their high watermark when over the last 2 weeks when the 10-year yield got up to 0.72. They like a steeper yield curve. And it also shows that the economy is gaining strength. I believe the dollar hit a 2-year low versus a basket of currencies yesterday and or this morning. Overseas markets were a little mixed. Um, maybe some maybe some markets in Europe and even the UK coming off big gains they had last week. And let's see what else maybe we want to touch on here. So we're going to get an Empire State. We got an Empire State manufacturing report on Monday. We're going to get a Philly Fed manufacturing report tomorrow. This is one of those regional Fed reports. They are worth looking at really to see if there's any consistency with what the regional Fed manufacturing surveys are reporting. They do get volatile once in a while. There is no annual smoothing for seasonal factors in those reports like there is for a lot of the reports that come out of the Census Bureau, the Department of Labor, the Bureau of Economic Statistics, et cetera, et cetera, et cetera. But we'll clearly take a look at that report when it comes out. And then, of course, we'll have jobless claims on Thursday. There is a chance that there will not be a show Thursday night. Still up in the air. If there's a way I can do it, I'm going to do it. I just have something going on that might make it a little tricky. So, really, I don't know that I have a lot else. I would certainly watch, in terms of market behavior, I would certainly watch this XHB home building ETF just because it's been one of the market leaders. It's had a big move. As I mentioned earlier, it's well above its February high. You definitely had strong numbers, and I think you will continue to have strong numbers in home building. But we just have to see, and I don't think rates are going up. I think mortgage rates are going to be low, right around 3% for quite a while. I heard one guy that I respect a lot today say that he thought that over the next 6 months they will get close to 2%. I just find that astounding and a little bit hard to believe. But this is the same guy that was saying mortgage rates were going to 3% 4 or 5 months ago, and I didn't. I thought I didn't believe him then, but he was right. So we'll see. You know, it's certainly, if you're thinking about buying a home and taking out a mortgage and have the credit and the cash to do it, it's certainly a great time to do it. It will continue to be a great time to do it. Even if rates don't go down, I don't see them going up in the mortgage market, at least for the next 9 months into the middle of next year, maybe even a little bit beyond. We'll see. That should be a major plus for the home building and housing market. And the other thing to mention on that regard is that when the home building market gets very strong, it has tremendous, uh, what some people would call pin action throughout a lot of parts of the economy that fly under the radar a little bit. Now, the home building stocks are not big cap stocks. Okay. They all used to be family businesses. They went public for different points in time. There were a couple of mergers, but none of them are top. I don't know that any of them are even in the S&P 100. I'm sure a number of them are in the S&P 500, but they are not big market cap stocks to the point where they're going to have a major impact on the uh, big market averages, although they're certainly big components of the housing and home building ETF, and they're going to drive that performance. The reason I mention it is, for anyone who's owned a home or bought a home or built a home, you'll probably appreciate the fact that in the home building process, that's not just the home building company, but you're talking plumbers, electricians, painters, HVAC people, landscapers. Sometimes the roofers are subcontracted. Sometimes the framers are subcontracted. Uh, Bricklaying, pavement people, cement people, anything and everything that has to do, a lot of subcontracted construction workers and skilled trade workers get a lot of employment. And not only them, but the local delis, the local sandwich places that they eat at when they're working, the the volume of business that they do with lumber companies, with building material companies. There's so many parts connected to the home building experience when it's on an uptrend, that it makes a major impact in the economy overall and in what produces the economic numbers for the GDP reports. When the housing market was just absolutely on fire, on its way to becoming a ridiculous bubble with the mortgage securitization business in 2004 to 2008 timeframe, the estimates were that the the everything connected to the home building, home buying, home furnishing, etc. market was close to 20% of the total economy. Now we're nowhere near that yet, but and it's one part of the economic activity that really wasn't in play nearly to the extent that it is now in 2019, even when we had this economic growth hit 3%, beyond which anyone would have ever beyond which people forecasted. And if you'll remember, even 3 or 4 years ago, you know, people had said, "Look, well, 1.5 to 2% growth is just the new normal. We just can't expect more than 1.5 to 2% growth." Well, we had it for about a year and a half. We had 3% GDP growth, and we had over 3% growth in average hourly earnings. Now, if you have if we get the economy to make some progress and get beyond the capacity restrictions that we have in all the indoor activities, and we get all the schools back, and we get all the people, maybe they'll be working from home, maybe they're going into an office. Uh, that will, and then we have the housing market and the home building market continue to trend higher. The economic numbers are going to be very strong. Very strong. So I'm just going to kind of leave it for that right now. I'm going to leave it at that right now. I appreciate everyone bearing with us the last couple days when, unbeknownst to me, I didn't realize there were, so many people in the chat. And because what the chat that I was looking at and what I'm looking at now that's brought into my feed here is I basically don't see anything. I do see the chat when I'm looking at the live version of the YouTube transmission. Thanks, Mark. That I'm seeing now. But this is the Anderson Report. I am Tim the Source Anderson. If you haven't subscribed yet to the YouTube channel, please subscribe. Hit that little red subscribe bar. Hit the like button if you like the broadcast. Hopefully you do. If you have any comments or suggestions, please fire them in. This is my Periscope channel is TJ Anderson 12. My Twitter handle is TJ Anderson 1. And please, everyone, have a great rest of the week. We will definitely be on tomorrow. Thursday is 50-50. I'll update that tomorrow or the next day. And obviously I'll put the scheduling out if it's going to be on. You'll see by checking my my Twitter stream or my YouTube notifications whether there's a show on Thursday. But everyone have a great rest of the week, and we will talk to you again tomorrow evening.